Good morning, everybody, and welcome to the Morning Volatility Report. It is I, Andrew Giovinazzi, Chief Operating Officer of OptionPit.com, welcoming you to our Morning Vol Report, or shall we say lack of it. But before we get to that, there is our class on Saturday. We're going to talk about interest rates, how they affect options, some interest rate sensitive products, ways that interest rates directly affect options versus the Greek row, which we haven't seen much of lately. I'll do the first part of the class. Mark will do the second part of the class. Generally, our Saturday classes, people like them, and we have clients for a long time because of them. So check it out. It will help set up what could be rising interest rates, over the next several years, and option positions that are a little bit more friendly to rising interest rates as opposed to what we've had, which is declining interest rates. And with that, on we go. That's this Saturday. So for all Option Pit Live subscribers and above, it is free. You will get a note on Friday about our webinar where you can just sign up for a free, you can sign up for free. Everybody else, you got to go pay and sign up for the webinar. Okay, so just go to our event page, click, and on you go. All right, speaking of the Fed, well, we had a referendum in, I guess, Italy. The Italian is out, and I guess we've got some short covering in the euro. Whatever, I don't quite know, but at least from a euro point of view, they like it. I think there's probably a little short covering here now that the news is out. Volatility is down in this product. I think long term we're going to probably see more volatility out of the euro because of this, but for now, it feels like the people are saying we're mad and we're not going to take it anymore. So I guess that's mildly bullish is all I can think. At least on the bounce today. Mostly, though, what you're seeing, too, if we look at right, Europe, Africa, FE, kind of a solid bounce. Solid bounce. All right, so if you're looking at something, it is not a terrible product. Also look at the vol. Again, you're starting to see stuff like this. You just the volatility, they crushed it. And again, I don't know exactly what a Trump presidency sets up for the rest of the world, but at least for right now, equity markets overall are liking it. What's not liking it is Treasuries, like the trend, whatever it is, it has still not really gone away. We had a little bit of a run a couple of days ago back up, but for the most part, the rate picture seems kind of set, and Treasuries in general, bonds, they're just becoming a lot less interesting to people. And again, it's the same thing with a lot of equities paying, 2, 3, 4, 5% dividends. Hard to justify staying in bonds. So again, we'll see what the shuffle looks like, but the volatility, if there is any left, is still centered around the 14th. The next Fed discussion, which is here. You're not. So again, this catches, right, this expires on the Friday, essentially the Wednesday of, we'll call it Fed Wednesday, this December 16 cycle. And also it picks up a dividend, so you might see a little bit of a vol anomaly, but there's still, any residual vol is after, right? Most of the forward volatility now is absolutely dead. So for Wednesday, and again, this is just very short carry times, but the volatility for the stuff, they've just destroyed it pretty much. And the market is just kind of quietly rallying back to where it was. So from that point of view, industries that produce things domestically, oil and gas production, stuff like that. Take a look at the XOP. That's something we look at a lot this year. It has made a nice little move. Probably expect it to go a little higher. We'll start looking at time spreads, things like that in here. Also, if the vol stays at this level, and again, this is as low as it's been in ages. I think simple positions like, puts in stocks and you forward sell some calls on a pop like that, I think could do okay. The volatility is literally is gone away from this. OPEC seems like they're going to be semi-serious. That's why I have a couple of puts around. But for the most part, it's a difficult market, but it could be just a coasty bull market. So time spreads, even double diagonals now start to look a little better depending on the pricing. And at the same time, domestically, banks. Every time we think that this rally is going to stop, they just don't stop. Because whatever the worm is turning somehow on the political scene with less regulation and, get rid of the guys or whatever, it is going right to the banking groups. They're just not, and they're not slowing down. So, again, I think the volatility in there is relatively low. Time spreads, you could probably protect it with a put, but those are the type of trades that look okay at this point. I'm not expecting a lot of, unless the Fed says something that is absolutely off the curve, which is always possible. I think you get more of the same. The only thing I would say is we're trying to look for a little bit of catch up here in the Qs. I'm not quite sure why they've sold off as aggressively as they have. I still think things will get better for technology companies. Mostly a lot of technology companies do have a lot of, a lot of domestic employees. So why the market has not liked them, I think it's just a massive rotation, but it's probably it feels a bit like it's still a bit of a buying opportunity relative to some other areas. And with that, just Qs. Just time spreads in the Qs. There is still some good latent volatility relative here in some of these nearer terms. Buy some of these back, into early January, late December terms, and I think you might like those trades. So that's the market we have. It feels like Christmas week already, and I don't see a whole lot that's going to change on that, at least for right now, especially with all the big ticket news items out of the way. So it just might be one of those slow rides up. Alrighty, and with that, you guys have a good morning, and I will be back in, back in our room in 10:15.